Miles with Asset Management, and I'm going to be providing a video on active versus passive or index investing. And to begin with, it's probably worthwhile covering off on what we mean by active and passive for those who are not familiar with the terms. Active management or active investing is generally considered investing where somebody has discretion over the selection of the underlying securities in the portfolio. Generally, it's a portfolio manager backed by a team of people inside an institution, and they make decisions as to whether securities are overpriced relative to their version of fair value or underpriced compared to what they believe fair value is. Index and passive investing are used hand in hand. An index is what is considered a broad representation of a market, and a passively managed fund is trying to replicate the performance of that index, either by buying everything in the index in the exact same way or buying largely what is in there, most of the constituents, but still getting the same kind of result. It's considered active. It's pretty obvious why active is called active, because you've got somebody actively making discretionary decisions. Passive is considered passive because there's no discretion involved in the decision-making process. However, passive doesn't mean that there's no turnover, there's no change in the portfolio at all, because index constituents, there are decisions that are made as to how the indices are constructed. So the number of securities that are in those indices, and maybe once a year, twice a year, quarterly, those index constituents are reevaluated and reassessed, and then the index is changed, and the passive investment vehicle needs to make those changes in accordance with the change to the index to be able to get the same result. So they're not 100% passive, but because there's no discretion involved, that's why they're referred to as passive investments. However, asset allocation can also be considered active versus passive. If you have if you have a portfolio that has a fairly fixed asset allocation, so a fixed percentage to equities, bonds, property, which may be rebalanced, once a quarter, once a year, something like that, we would consider that a passively managed asset allocation strategy, often referred to as a strategic asset allocation strategy, versus a more active approach where the underlying asset classes themselves are assessed as whether they are expensive or cheap, and the asset allocation is changed throughout time proactively by an investment manager such as Innova. And given that studies have found that 90% or more of the return variability of an overall diversified portfolio comes from the actual asset allocation that the client holds, that's where we devote most of our time, because that's where the majority of the risk actually comes from. Over the last few years, active managers have been largely shunned for passive managers due to the underperformance of active managers, as passive has done extremely well post the GFC. This is particularly prevalent in the US, where passive, there's a debate as to how much, in terms of capital, they make up. We're talking about in equity markets, maybe 50 to 60% is in passive. However, and in bond markets, I think it's about 30 to 40%. However, when it comes to the actual flows of money, passive is by far the most dominant player in that marketplace. And with that comes certain risks. If you think about how an index works, a passive fund trying to replicate that index, as money flows in, the assets that are bought indiscriminately. So there's no discretion involved, they're bought indiscriminately, and as redemptions go out, they are sold indiscriminately as well. And if there's no flows at all, well, then there's no flows at all. This can pose a problem if passive becomes too large a part of the flow in the marketplace, and there aren't enough active managers available, because active managers, in theory, help with the price discovery process. Because they are making discretionary decisions that are educated, well-researched decisions as to what the price of a company actually is, you should, in theory, have a more efficient market and greater the price that is representative of the company should be much closer to what the actual value of the company is when there's more active management involved. When flows and the total capital is dominated by passive, you have a situation where that discretion is not being made and the price discovery mechanism breaks down somewhat. And we believe that may be one of the reasons for the viciousness of the March sell-off. This is where algorithmic trading comes in. Algorithmic traders, a lot of them trade based on an algorithm, obviously, that targets a particular volatility level. And if volatility starts to pick up because there are an increased level of redemptions because people are worried about something in particular, they're going to breach their capped volatility target, and so they become sellers into the market. Now, if there are no active managers on the other side to buy those assets, as they sell with no buyers, that lowers the price even further and increases the volatility, which means they need to sell more. And this creates a vicious cycle that can happen very, very fast, which is what we saw in March. So, in fact, the active manager, their job is not only to outperform the market, but it's also to provide price discovery, as I mentioned, as well as liquidity. So the risk in using an entirely passive portfolio, one, when passive becomes too large a part of the market, there's that price discovery mechanism can break down. Two, the liquidity providers in the market, the natural buyers of assets as they fall in price, are not there to be picking up those assets and providing a floor to the price, or at least dragging out the drawdown over time as they find assets become more and more attractive over time. But there are other risks as well. If you're invested completely in a passive portfolio, however far the market falls, that is what you're going to get. You're going to get the full market fall. You would hope that a discretionary manager, an active manager, depending on how active they are and depending on whether they're any good or not, are able to actually protect some capital on the way down. You don't have that with passive investment vehicles. Their job is to just replicate what the market index is telling them. And so if the market's down by a particular percentage, they're going to be down by a particular percentage. Innova's approach to the active versus passive optionality, we find that people generally sit in one of two camps. They're either all active or all passive. We think this is silly, and in fact the debate between active and passive is probably one of the dumbest arguments being had by some of the smartest people on the planet. There's a role for passive and there is a role for active in portfolio construction, and why you would throw out half your toolkit makes no sense to us at all. Where we think that there are markets that an active manager can add value over and on top of what we could get through a passive index and over and on top of the fees that they charge to do so, we may use an active manager. However, there are other markets that are largely efficient, or where we think the returns are going to be so dominated by the actual market return itself that any value added by an active manager is almost inconsequential, that we may use a passive instrument to allocate to that market. And so we don't think it makes any sense to limit your options to one versus the other, and to one dogmatic belief that the market's perfectly efficient, so always being passive, or no, all markets are inefficient, so therefore always being active. We think, as I said, why throw out the tools in your toolkit? If you utilize everything that you have available, you could get the best, with the goal to get the best result. Focus on where you can add the most value. And it so happens that the most value can be added actually in the asset allocation space, given that is where 90% of return variability comes from. So it's the asset allocation decision itself, hence why we've included that in the active versus passive component, and why we focus so much on it at